This video is about risk and return. What is risk? Risk is a measure of the uncertainty surrounding the return that an investment will earn, or more formally, the variability of returns associated with a given risk. We have two examples here. Example for high risk investment is you invest in share. A 1,000 investment in a firm's common stock is very risky because the value of the stock may move up or down substantially over the same 30 days. Example for low risk investment is you invest in government bond. A 1,000 government bond that guarantees a holder 5% interest after 30 days has no risk because there is no variability associated with the return. So what is return? Return is the total gain or loss experienced on an investment over a given period of time, calculated by dividing the asset cash distributions during the period plus change in value by its beginning of period investment value. So component of return, we have two types of component of return. The first one is capital gain or loss, which is the change in investment values, or current income, any cash distribution, for example, you receive dividend or interest payment. Formula to calculate return is ending value minus beginning value plus total current income divided by beginning value times 100. So calculation of return, this is example to calculate return. At the beginning of the year, Apple stock traded for $90.75 per share, and Walmart was valued at $55.33. During the year, Apple paid no dividends, but Walmart shareholder received dividend of $1.09 per share. At the end of the year, Apple stock was worth $210.73 and Walmart sold for $52.84. So to calculate return on Apple, you put all the figures in the formula. So the ending value is 219.73 minus the beginning value 90.75, beginning value 90.75 plus 0 because Apple has no current income, Apple pay no dividend, divide by beginning value which is 90.75 times 100, so you get 132.2%. For return of Walmart, ending value minus beginning value plus total current income divided by beginning value, so 52.84 minus 55.33 plus 1.09 which is the dividend payment, divide by 55.33 times 100, you get 2.5% negative. From this example, we can say that if you invest in Apple, you get positive or you make profit of 132.2%, but if you invest in Walmart, you make a loss of 2.5%. Let's move to the risk preferences. Economists use three categories to describe how investors respond to risk. The first one is risk-averse. Risk-averse is the attitude toward risk in which investor would require an increased return and as compensation for an increase in risk. So most of investors fall under risk-averse. The second one is risk-neutral. Risk-neutral is the attitude toward risk in which investors choose the investment with higher return regardless of its risk. So risk-neutral investor does not care about amount of risk in the investment. The third type of risk is risk-seeking. Risk-seeking is the attitude toward risk in which investors prefer investment with greater risk even if they have lower expected return. Now we move to the capital asset pricing model, which is the CAPM. The capital asset pricing model is the basic theory that links risk and return for all assets. The CAPM quantifies the relationship between risk and return. In other words, it's measure how much additional return an investor should expect from taking a little extra risk. So under the CAPM, type of risk can be classified into two, which is diversifiable risk or non-diversifiable risk. What is diversifiable risk? Diversifiable risk is the portion of an asset risk that is attributable to firm-specific random causes. So it can be eliminated through diversification. It's also called unsystematic risk. For example, management risk and leverage risk. If diversifiable risk happens, it's only affect that company only. For example, if the management of the company is bad, it's only affect the company itself. It does not affect any company in the same industry. For non-diversifiable risk, it is a relevant portion of an asset risk attributable to market factors that affect all firms. It cannot be eliminated through diversification. It's also called systematic risk. For example, political risk, pandemic risk, and economic risk. So non-diversifiable risk, if it's happened, it will affect every company in the industry. For example, for COVID-19, the risk now is affected all company in the industry around the world. So how we can reduce our risk in our investment portfolio? We can reduce the risk by adding more number of securities in our portfolio. So if you refer to this diagram, for example, if you invest in only one securities or one asset, so the total risk is very high because you need to bear non-diversifiable risk and you need to bear a high level of diversifiable risk. If you want to reduce the diversifiable risk of your portfolio, you must increase the number of securities or number of assets in your portfolio. So instead of only invest in one company, you can invest in more companies. For example, here you invest in 20 companies. If you invest in 20 companies, if you refer to this diagram, you still need to bear the same amount of non-diversifiable risk, but you can reduce the amount of diversifiable risk of your investment portfolio. This is formula for capital asset pricing model, which is a CAPM. So the formula is RI equal to RFR plus beta I times RM minus RFR. So RI is the expected return of investment I, RFR is a risk-free rate, beta I is a beta of investment I, RM is return of market, beta I times RM minus RFR is also known as risk premium. So investment decision, invest if return offered by the asset is higher than RI calculated in CAPM model. So you need to take notes here. Beta for market is 0. Beta for risk-free rate is, beta for market is 1. Beta for risk-free rate is 0. This is example how to calculate return by using CAPM model. Calculate expected return of Wire Incorporation if the beta for a company is 1.2, market return at 7%, and risk-free rate at 4%. Would you invest in Wire Incorporation if your required rate of return is at 6.3%? So if you look at this example, you plug in all the figures. RFR is 4%, beta I is 1.2, 7% is for the market return, so you get 7.6%. That means the return given by this company is 7.6% and your target return is 6.3%. So you need to invest because this company offer higher return compared to your target return. Next, we look at security market line, or we call it as a SML. When capital asset pricing model is depicted graphically, it's called the security market line. It reflects the required return in the marketplace for each level of non-diversifiable risk, which is beta. In the graph, risk as measured by beta is plotted on the x-axis and requires return, which is R, are plotted on the y-axis. The risk-return trade-off is clearly represented by the SML. So this is example for SML, security market line. How to draw this line? First, you must know that the return, the RFR given in this example is 7%. Risk-free rate, the amount of beta is 0. So you plot point for risk-free rate, return 7, beta 0. So you get 1 point. And then for market return, you need to remember market return given in the question is 11%. But the beta for market return is 1. So you can plot point for market return 11, beta 1. So you get 2 points here, one for risk-free rate, another one for market return. So you combine these two lines, you get security market line. So from this diagram, you can see that the risk and return trade-off, where in finance we believe low risk, low return, high risk, high return. So if you can see from this example, risk-free rate is considered as a zero risk investment, have a low risk which is 7% compared to the market return with high risk, risk equal to 1, offered a return equal to 11%. This is example for application of SML. Based on SML, would you invest in the following investment instrument? The market return is 7% and the risk-free rate return is at 4%. So you have three stocks here, stock A, B and C. Stock A, return offered is 8%, beta 0.8. Stock B, return offered 2%, beta 1.3. Stock C, return offered 11% and beta is equal to 2. So to make investment decision, you need to calculate return by using CAPM. Okay, so you can calculate the return by using CAPM. For stock A, return CAPM is equal to 4% plus 0.8, which is the beta, times 7% market return minus RFR 4%, so you get 6.4%. And you calculate the return CAPM for all stock in this example. So for stock B, the return CAPM, you get 7.9%. Stock C, you get 10%. Then step number 2, you need to draw your SML. So how to draw the SML? First, you need to plot the risk-free rate point. So risk-free rate, beta is equal to 0. Risk-free rate is 4%. You plot 1 point here. And then you plot point for market return. So market beta is equal to 1. Return equal to 7%. So you get another point here. Then you can combine, you can draw one straight line by combining risk-free rate and market point. After that, you can plot the stock based on the return offered. For example, stock A, return offered is 8%, beta 0.8. So you plot 1 point here, 8% and 0.8. For stock B, return 2%, beta 1.3. And then for stock C, beta 2, return 11%. So by plotting all the stock in the SML graph, you can make investment decision. So based on this diagram, you have two stock fall under invest area, which is stock A and stock B. Why you invest in these two stock? Because return offered is higher than CAPM return. For stock B, the return offered is only 2%, but the CAPM return is 7.9%. Therefore, the company should not, or we should not invest in stock B.